Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 307 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning to you, Matt. It's been a few weeks since we've been on together with crazy schedules, but good to be back on our routine.
It is good to be back on the routine. It's interesting. I've had several comments from clients and friends of the podcast. They're like, so when's the next time you and Mark are going to be back on the podcast? This is like the last couple of weeks. And I think they just wanted to hear our insights, or maybe they just love our banter.
It could be. Well, I think we have a lot of good content as we get back to kind of our normal podcast schedule over the next couple of weeks. So hopefully everybody enjoys it. But before we get into this week's show, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click the schedule initial call button and then select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. And it just so happens that today is July 1st, so this will be the month and data for June this year. S&P 500 index up 5% for the month of June and up 5.5% for the year. The Dow Jones Industrial Average up 4.3% for the month and up 3.6% for the year. The NASDAQ Composite Index up 6.6% for the month and up 5.5% for the year. The small cap Russell 2000 ETF up 5.2% for the month and down 2.3% for the year. And then the Vanguard All World ex-United States ETF up 3.1% for the month and up 17.1% for the year. 3-month Treasury rate at 4.41%, the 2-year Treasury rate at 3.72%, and the 10-year Treasury rate at 4.24%. So moving just right into tweets, articles, and research from this week, Matt. The first two things, that I wanted to talk about is kind of like opposite day, right? Where something happens in the markets or the economy or in the geopolitical realm, and you expect the market to react one way, and it just does the complete opposite. So example one of this, and Jenna will put this up on the YouTube video and it'll be in our show notes, but Charlie Bilello sent out a tweet on June 23rd. And he said the U.S. bombed Iran over the weekend. Naturally, stocks rose 1% today while crude oil fell 9%, just as everyone predicted. And I thought that this was pretty interesting. And we've seen this before too, right, Matt, where we have some sort of conflict going on in the Middle East and short-term oil prices rise because naturally investors are concerned that, transportation paths are going to be disrupted and supply chains of oil are going to be constricted. So naturally, when people think there's going to be less oil available, prices go up, right? But in fact, this was last Monday, the 23rd, and this was, again, just right after the U.S. carried out the airstrikes in Iran. Stocks are up 1% and oil fell significantly. And my next example of this, Matt, before I get your opinion, is a post again on X from Sam McCallum on June 18th. So Sam said new all-time highs for the Israeli Tel Aviv Stock 125 Exchange Index. Makes perfect sense. So again, June 18th, that was right after Israel carried out military operations in Iran, and there were retaliatory strikes by Iran. And again, just a few days later, the Tel Aviv stock market was at all-time highs. So again, even if you had the news in these two instances early, I think people would probably make the wrong call from an
Well
investment
said.
standpoint. And I think that's something that just continues to fascinate me about the markets is that, when you think for sure what XYZ stock or this sector has to react in this way to this news event, a lot of the times it's just the complete opposite.
No, I think it's well said. And on two podcasts ago, not the one last week where you were quarterbacking that event in Columbus, but the one before I did solo, I talked about how I thought the likelihood of a melt up into the end of the quarter was likely. And when you see the market going up on that type of news, my gosh, is that bullish,
Yeah.
right? And I think you said it perfectly. If we had that news, we had the news headlines ahead of time, people would have expected the market to react a lot differently than it ended up. And the fact that it did end up so bullish the final 2 weeks of June and all those dips got bought relatively quickly, what does that tell you about underlying risk sentiment right now?
Yeah, I think, we always like to say, I think, your favorite term at one point a couple of years ago was, you like to see the market climb a wall of worry, and that's
Yep.
exactly what it's doing right now. There's a
Yep.
lot of unknowns and what people would classify as risks out there right now. But the market, at least so far, has continued to go up. And oh, by the way, the 90-day tariff pause is over in the middle of next week. And we still really haven't seen any weakness going into that. Now, I know there's been trade deals that have gotten done. There's still a lot of negotiations ongoing.
Yep.
But that's another thing that's coming up that, in my opinion, hasn't really been talked about that much. That's, could pose another threat to the market continuing to move higher. But haven't seen any sort of prolonged volatility since the weakness in early April.
Well said. Well,
So
I'll take it, by the way.
yeah, I will too. I'm not complaining by any means, but the last thing I had was again one of our favorites, the magazine covers from The Economist. So this
Here we
was
go.
their talking specifically about their April 2025 magazine cover, and Jenna will put this up on the YouTube page and also in our show notes. But just stepping back, I talked about this briefly in the last podcast episode, which was, like you mentioned, the investment panel I moderated at the Ohio RIA Summit in Columbus. Again, back in October of 2024, The Economist had a magazine cover of a wad of $100 bills, so a wad of Benjamins on a rocket ship towards space. And it was shortly after that, in the beginning of 2025, when the dollar collapsed. And this is the weakest we've seen the dollar in quite some time. So now this magazine cover comes out, which sports the title "How a Dollar Crisis Would Unfold." And it's like a upside down money bag as a face of someone that's like concerned, right? I'd like to see who the artists are for these magazine covers, by the way. But now to my point again, is The Economist going to be wrong again? And is this a point in time where the dollar will begin to strengthen from here through the rest of the year? And I think while we might not have seen the dollar climb yet, we've seen U.S. stocks start to show more strength recently over the past couple of weeks relative to international stocks, because as I read out in the beginning of the podcast, international equities have been dominating U.S. equities so far this year. And a stronger dollar, some signs of that are, strength from U.S. stocks, U.S. treasuries, real estate, and a stronger dollar hypothetically could hinder the strong international outperformance this year. So just throwing it out there again. This was the April cover. I believe it was April 25th that this magazine came out. So again, wouldn't surprise me if the dollar strengthened from here.
Yeah, I mean, I think you coined it perfectly a year or two ago, which was something along the lines of the minute it hits the covers of these types of magazines, you're pretty much past the peak, usually.
Yeah. Yeah.
And the other kind of side to this weaker dollar, especially over the past couple of months, is we got to think about these mega cap multinational names. So I'm just going to cherry pick, and this is not a recommendation for or against, but let me just pick on Apple, right? So for our listeners and viewers, when Apple makes money overseas, when they convert those euros, let's take, for example, back to dollars, when the dollar's weak, they're buying more dollars. That tends to be a tailwind for their profits. So I'm going to be a forecaster here. We're going to get to the end of July. We're going to hear all these earnings. I would be a bit surprised if some of these big mega cap multinationals report surprise tailwinds from FX currency exchange that allows them to have potentially some better numbers. We'll see if my forecasting's right, but I have a feeling that might be the case. Not a recommendation for or against Apple on that, but just an example.
Yeah, that's a great example. And again, just to take that a step further, when we're talking about, how currency plays into the stock market, let's just say that a French stock gains, say, 10% in euros, right? But the euro versus the dollar weakens 10% in that same period of time. Then your return in dollars is essentially nothing, right? So that's kind of how that plays into to markets, especially if you're a U.S. based investor investing in foreign stocks and equities of the sort. So, but that's all I had for tweets, articles, and research. So I will turn it over to you.
My first comment, and it was very hard coming up with my list of content. Not because I didn't have much, because I had too much. Okay?
Good problem to have.
Good problems to have. All right, so here we go, listeners and viewers. Get ready. First piece. Market. This is a pretty interesting statistic from the Subu Trade on June 27th. Jenna will put up this chart for our YouTube viewers. It shows a data set, Mark, for when the S&P 500 rallies from being down 18% to a new one-year high within 3 months. So what you're going to see here is the data set is not very wide on this. 1933, 1935, 1982, year I was born, 1988, 1998, 2003, 2009, and then now. So 3 months after this occurs, on average, market's up about 6.81%, and then 1 year later, about 21%. There hasn't been a negative data set on the 1 year timetable. Quite interesting. Doesn't guarantee the next year is going to be positive. Got to give that side of it. But looking through the lens of history, that's not bearish. So it got me thinking. It's been a couple of podcasts since I referenced the performance when we've given similar statistics. So, Mark, I did a little deep dive yesterday, and I found episode 295 that we published on April 7th. And during that, we talked about some forward-looking stats when the volatility or the VIX index gets above 45. Jenna will put up and recycle this graphic and this data set that we shared on that April 7th podcast. And what that data set told us is when that volatility gets above 45, the forward-looking returns 3 months later on average for the S&P is a little bit over 11%. Well, I went to stock charts yesterday, timestamp this. You ready? 10:43 a.m. yesterday, so you know where the data is coming from. And since April 7th through 10:43 a.m. yesterday on June 30th, the S&P was up 21.89%. So if you're a listener or viewer and you're wondering why we look at history as one of those data set reference points, that's an idea of why we do it. Doesn't necessarily guarantee it's going to have that same outcome, but it gives us a map of how things generally react. Mark, your comments.
Yeah, my first thought is just like, wow, like going back into the capsule, baby, to bring this data back is great. And we should probably do more of this when we give out this type of data and say, hey, last time X happened, the market did Y over the next 3 months, 6 months, or a year. So I love that you're doing this, and it's again, it goes to show that I think following and paying attention to hard data and hard facts is a lot better and will serve you better than listening to the news and people's opinions on what is going on in the world. And this is just a perfect example of that.
I'm going to add to it then. Since I got your ear and you're loving it, I got another example. You ready? March 20th, episode 292. Market was selling off pretty quick. We were sharing a piece from Seth Golden. Jenna will put up this chart for our YouTube viewers. What you're going to see here is Seth was showing a piece from FundStrat's Tom Lee. I'm a Tom Lee fan. And at that time, the date on the piece, the research piece, Mark, was March 14th. And it showed the list of the top 6 fastest 10% corrections in the S&P 500 going back to 1950. And what it was showing is that what occurred in March was number 6. Okay? The forward-looking returns when the market sells off that quick, looking at the lens of history, was about 8.2% on average 3 months later. Ran the same statistic yesterday. March 14th through yesterday, June 30th at 10:46 a.m., the S&P was up 11.96, and the 3-month average with that data set again was about 8.2%. Again, another data set that we shared, and it came out relatively in line through the lens of history. Doesn't guarantee it's always going to work that way, but you just said it a couple of minutes ago. It gives you an idea on how the market tends to react when price action is similar compared to history. Well said.
Yeah, well said. And it goes back to a popular quote in our industry that is history never repeats, but it often rhymes.
Well said.
And these type of instances are important to take note of in the past, so that going forward, when something similar happens, you have a set of data you can go back to and make informed decisions.
Well said. Nothing to add. My next piece, the QQQ, which is a popular ETF that tracks the NASDAQ 100, not a recommendation for or against. Bar chart had a piece. Jenna will put up this for our YouTube viewers. I'll read it for our traditional podcast listeners, Mark. NASDAQ QQQ forms a golden cross for the first time since March of 2023. The last one sent prices soaring 82% over the next 23 months. This is according to Bar Chart. Timestamp on this is June 24th at 6:17 p.m. Will you spend a minute or two explain to our listeners and viewers what's a golden cross and what's the opposite called a death cross?
Yeah, so a golden cross is simply when the 50-day simple moving average crosses above the 200-day simple moving average for a stock or a index. So again, for people maybe newer to the markets, moving averages, a very popular technical indicator that signals kind of if we're in an uptrend or a downtrend. So you want to see the stock price above the 50-day and the 200-day most of the times, and most often people classify that as us being in an uptrend and vice versa. Prices below those moving averages, and we're in a downtrend, or it could be classified as the stock or the index being in a downtrend. And you always want to see the shorter term moving averages above the longer term moving averages, right? That means prices moving steadily higher. So as you can see with this chart, in March, the 50-day had the quote unquote death cross and crossed below the 200-day moving average, meaning, hey, over the past couple of months, stocks have probably been pretty rocky. So just a nice way to define uptrends and downtrends.
Well said. I think it's interesting because this was pretty much buried. There wasn't a lot of headlines about this golden cross, but oh, we do a death cross. It's got clickbait everywhere. It's on the front of XYZ
Right.
financial site. Oh, this is a big deal. And that's just me, just jaded right now with the financial news media. All right, next item I want to throw out there, also bar chart. It's a comparison of small caps versus mega caps. This will be relatively quick. Bar chart posted this on June 28th. Jenna put up this illustration for our YouTube viewers. This will be in our show notes. Small caps are now underperforming mega cap tech stocks by the largest margin in history. And it looks like the data set on this goes back to the late 90s, Mark. Again, I think it just shows a relative weakness of small caps right now in general. Your comments?
Yeah, it's been pretty amazing the past several years. I mean, really since kind of like the post-COVID era, like how badly small cap stocks have underperformed their larger cap peers, and especially larger cap tech, since that's kind of what's been dragging the market higher. But yeah, I mean, like you said, the last time the relative valuation has been at these levels was 2000, the year
Yep.
2000, which is
And small
25
caps
years
were on
ago.
a ripper for the next following couple of years in the early
Yeah,
2000s.
so in my opinion, this would be a logical place for small caps to turn it around and start to outperform. A rising dollar should help that, and we are starting to see some of the small cap indexes move modestly higher over the last couple of weeks and start to show at least a little bit of relative outperformance. So it wouldn't surprise me if this was the place that over the next couple of years, small caps started to strengthen. But, you could have said that at any point over the last 25 years and been wrong. I mean, if you look at this chart, you've seen small bouts of outperformance from small cap names for, anywhere from 6 months to a year and a half, but it was pretty short-lived, and so it's very I would say rare for small caps to underperform for this long, especially coming out of like economic crises or bear markets or severe corrections. Small caps tend to lead the market off of the lows. In the past couple of years, that just hasn't happened.
Well said. It makes me think about when you were saying all that is the relative outperformance of international right now, right? Because the stark performance difference of international to domestic equities is dramatic. But for if you were an international stock investor, how long did you underperform? And we're talking decade plus you underperformed American indices.
Mhm.
And I'm gonna play this out real quick. If a client called me up later today and said, "Hey, I was listening to the podcast. I heard you talking about international. Hey, I want to increase our international exposure," I'd be like, "No, you don't," because demographically, the trends are against them. I'm talking about productivity. I'm talking about growth rates and just the equities, just in general. All the statistics are against you if you're a long-term investor in general, international versus domestic. That's not something I could advocate for. Just want to throw it out there. Might be a hot take. I don't know.
Well, yeah, and I think it's important to note too that it's only been 6 or 7 months that we've seen this drastic outperformance from international stocks, like this chart that you just pulled up. The international equities versus domestic U.S. equities looks exactly the same, except maybe even going back a little bit further. And I still need to see more for this to be a longer term trade, in my opinion, to overweight international stocks
Yeah,
or shed some domestic equity exposure, because we could be in a scenario where it's just one of these 6 month periods or a year periods where international does well, and then you revert back to the long term trend, which is dominance by U.S. equities.
yeah. I mean, look under the hood. In essence, in my opinion, the fundamentals aren't going to back up these numbers over time. My 2 cents might be a hot take. All right, next thing I want to talk about, American consumer. Cheddar Flow had this post on June 26th. I think this is going to be very enlightening for our listeners and viewers, Mark. What it shows is how dramatic the top 10% of American consumers drive the American economy. The latest data, Jenna will put up this chart for our YouTube viewers. This will definitely be in our show notes. Is that the top 10% of American consumers now consume nearly 50% of all the spending. That's dramatic. And
Mhm.
so when we think about where the stock market is right now, when we think about where real estate market is or the state of the economy, I would argue that those 10% of the top American consumers, their sentiment on how things are going could, to a certain extent, dictate how much they're spending. And I bet things were a little dicey in March and in early April. But compared to now, I'd argue the psyche of that top 10% American consumer is not bad. And I would argue that things might be a little bit better than the market or the economy might be indicating for that top 10% doing 50% of the spending. My 2 cents might be a hot take, but the bottom 60% mark do less than 20% of the consumption. And so I think it goes to show you how important that top 10% is for the American economy. Your comments.
Yeah, I think, whether people like it or not, and I don't want to get into the political side of this discussion, but the top 1% income earners or asset owners pay what 90%, 95% of the taxes in this country. The top 10% spend about 50%. So it shouldn't surprise people, I think, that this is the way things are right now. But interesting nonetheless. And I think as long as you continue to have, the top 10% of income earners in this country continue to spend, it's hard to have an economic slowdown, right? If you have over 50% of the people in this country not changing their spending habits at all, where is the slowdown in growth going to come from? Is
Yeah,
would be my question.
yeah. I got another potential hot take for you. I'm just full of them today. One thing I was talking about with a client yesterday is just where we're at with this interest rate cycle and taking personal politics out of the conversation. It's no secret that the current administration wants a new Fed chair, and that could happen over the next year or so. And that new Fed chair will most likely lower rates, maybe a lot more quicker than the current Fed chair. And what it could lead to is lower mortgage rates. And the conversation I was having with this client was surrounding the consumer. Because what I could see happen if I were a fortune teller over the next couple of years is if longer term rates end up coming down, you're going to now have a consumer who is going to start tapping into these huge equity gains they've seen in their real estate, in their home the last 5, 6 years, and they're going to do refinances, home equity lines of credit, and all of a sudden they're going to cash out some of that equity, and that's going to be kind of the next fuel to the fire for the American economy, just like we see it happen in the 90s and the 2000s. I think we're going to have a rinse and repeat scenario potentially over the next 2, 3, 4 years, and that could be kind of the next cycle that fuels the American consumer, because if you think about it, the average consumer has not been able to touch those huge equity gains.
Yeah, that's a great point. That's a great point. I think you're going to have a lot of that over the next several years potentially. So yeah, I mean, if I know one thing about the average American consumer, they love to spend, and it would take some really hard times to 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 turn that in the other direction, I think is the best way to say it. So
Yeah, this is a good
um,
podcast, Mark.
yeah, I think it was a lot of good information, and I think we'll leave it there for the week, Matt. But anything else before we leave it there for the week? I know it's the official start of the second half of the year today. We're going to have earnings season with the banks here coming up in the next couple of weeks. It's hard to kind of believe that, as I feel like we just got done with the previous earnings season. And like I said, July, I think it's July 8th or July 9th, the 90-day tariff pause is up. So we'll see if there's any new sort of news that comes out surrounding that. But yeah, a lot of stuff going on right now.
Yeah, I think if you're seeing the market stay resilient in the face of some tough headlines regarding tariffs in a week, you got to take note to that, right? If we continue this, people buying the dips, and that shows underlying positive momentum. Last comment is next Fed meeting is July 30th, in about 4 weeks at the end of the month. So we'll hear from the Fed. We'll get earnings season. We'll continue the hot content. So looking forward to the podcast here in July. I think we're gonna have a lot of good stuff for people.
Yeah, I agree. And the last thing I will add is that looking back at history and seasonality of where most of the gains come from throughout the year, the first half of July does tend to be pretty strong for stocks, and most of the July gains are done in the first 15 days of the month, with the caveat that this year could be different. But I just wanted to throw that out there, that even though we might see some more negative news headlines over the next couple of weeks, again, wouldn't surprise us at all if the market continued to climb that wall of worry we talked about. So
Well said.
we will end it there for the day. Matt, thanks for the time. And thank you, everyone, for listening to episode 307 of the Independent Advisors podcast. And we will be back with you next week for episode 308.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.